and all these other stocks, and everybody was talking about the Trump bump. Blake was here November 20th. You can go, you can read it online, and he wrote, "It's a new day. However you feel about it, and all new days call for a different approach and a new set of stocks and even entire sectors to watch. There are clouds on the horizon, talks of tariffs and warnings that retailers are suffering. The dominoes appear to be falling on imports and Chinese stocks." That was back in November when everyone was enjoying the all-time highs into February. He was well ahead of it. And the Mag 7 since then has absolutely been crushed. From peak to the valley of this year, it has been as down as much as 27% for the Mag 7. About 35% of the market moves through 7 stocks. The other 493 stocks have a very limited impact on the markets. All your ETFs, the SPY, the QQQs, all these stocks and all these ETFs, they all move together, money crowding into it, funds buying up these stocks. And you could see this stock market absolutely took a bath starting in February, and Blake was well ahead of it, going all the way back to November. This is the difference between what everyone else is doing right now, panicking in the street. Markets, Mag 7 down 20%, S&P 500 down 10%, NASDAQ 20%. Blake's up to year to date 2.3%. So this is important. If you are retirement planning, if you are a person who is thinking about what your future is going to look like, what you're going to do with your 401k, what you're going to be doing with your capital moving forward, you need to be paying attention to this, because we tore up the tired rules of investing and planning long ago. 60/40 is under a lot of duress, and a lot of fund managers continue to reach out to their clients and say, hey, stick with us, stick with us, stick with us, keep your money here. Well, in reality is you can do a lot better of a job than they can. And if you have the right guidance and the right people behind you, and you listen to this presentation today, you would not be concerned at all about what has happened over the last 6 to 8 weeks. Instead, you'd be up on the year. And we're starting to see, with something new that no one else is talking about, but we are going to let you see behind the curtain today of how it all works. I want to introduce you to Blake Young. He is trading Forex and futures for over 25 years. He has been a principal for a commodity trading advisor, CTAs, and a hedge fund manager, a senior currency analyst and financial market instructor for 25 years. He has created dozens of unique educational courses and offerings and instructed thousands of new and seasoned traders over the years. Blake likes to say, I would rather miss a good trade than take a bad trade. And this year has been full of bad trades. But as you can see with the results, up on the year. Blake, thanks so much for taking the time and joining us today.
Thank you. I appreciate that.
Absolutely.
Yeah, it's been wild, right? I mean, it's been a wild ride. We saw a lot of changes. And, I appreciate the introduction. It's, when we have people like Garrett who have the experience they do, and we have the opportunities to work with each other. My training is in economics as well. But I also had a little bit different experience. Why I went into futures and Forex is because I was doing importing. And we joke, because I sent out a newsletter on that one too, saying I'm an importer exporter, because we joke about that, playing back to the Seinfeld idea that, I'm an importer exporter architect, right? Art Van delay. But we did export once. We exported potash once. So we truly were importers, exporters. We just brokered a deal for some potash out of Utah. Utah's a big potash producer. But, it's like you said, it's not just the training, it's the practice and the experience like you've had in certain areas in agriculture, I've had in importing from China. And that's kind of why we saw these things coming. And this is the whole point of what we've done in this market. And I know that the people that are in deep currents have seen this coming, and the people that are following our posts and our newsletters and our updates were able to defend. One of the things I'm going to teach you early on is these crosses can give you days, weeks, months, quarters, and years of trends and advance notice to what these are going to do. So we can read the news, we can watch that information, but these changes and these moves, you can see these swings. And these swings from the crosses here, which I marked, just made it a little bit easier for you to see. Those crosses can be into super long-term trends. And those long-term trends can give you opportunities to defend, can give you opportunities to run. They can give you opportunities to participate or step into a cash position. So all that's there. So as we're looking at this, one of the things that we're going to do is we're going to walk you through how to see these ahead. I'm going to walk you through some of the historic correlations and the expectations we would have going into this so that we know what to look at for the next step. So number one, why are you here? Well, you're here because maybe you are looking for a way to manage what you've seen already happen. Now that's the problem, isn't it? We can always see when it's too late that we should have, could have, would have. So my question for you, if we're looking at this, are you here to outperform the market with less risk? Because that's what we're doing. Are you here because you want to build the portfolio with us starting day one? That's what we do. We're going to talk about using correct asset allocation. We're going to also know which investments are the strongest, which ones are going to generate the solid return with the least amount of exposure. Identify the biggest 4 threats to your retirement and how to avoid those. But we're also going to talk about how you can take control of your financial future, even in this crazy market. So we're positioned for this next deep current. And we're seeing the shift. We're seeing the shift move along. As we're looking at that, we're seeing that shift and that change in the markets. It's already underway. I've shown you those big X's. And so now it's a matter of timing into the next wave. And just like when we're talking about an ocean, just like when we're talking about a river, just like we're talking about any body of water, and I'm a swimmer. That's the fact is I like to reference it as catching a current. It is easier to swim with the current than against the current. So when we capture these currents, like what we did in AT&T, there are times, even in this pullback in the markets, AT&T gave us a strong signal. And so we were able to get 250% return on risk based on our exposure by trading a long stock, covered call, collect the dividends, and protect ourselves so that we couldn't lose while we're getting in and collecting that dividend. And exactly what we did. For those of you that are already in the deep currents, you already participated in that. We showed you we were able to buy a put, eliminate our risk with that dividend in a very structured strategy of playing for that dividend in a long stock covered call scenario on an equity, even in the pullback, but knowing how to time that into AT&T, even in a pullback, that's part of what we do. So we also had other currents set up, for example, utilities. And you might say, why are we buying into utilities? It's not trading up, it's trading flat. Well, we had opportunities to see these bounces and pullbacks, and utilities are a fixed income substitute for the way I trade. And so we were able to get 124% return on risk by playing these 2 short-term waves inside of a bigger wave, which I'll show you in a minute, in conjunction with fixed income. Now, I know there's some questions coming through. There's some comments coming through. Because I have some material I need to get through first, be aware, I'm gonna come back to those questions as I can. But right now, please type them in. Type them in while you think of those questions. Put those in anytime you want. We will come back and circle back to some of those questions at the end of the presentation as I show you some of the setups. But there's material I need to get through in the time that we have. So feel free to put those in. I'll come back to as many of those as we can at the end, okay? But feel free to put them in. Just be aware, I'm not ignoring you. We're going to get back to those, but there's material that we've got to cover. Because right now, in this current market, it's shifting. We're seeing changes, we're seeing shifts, we're seeing movement in the market that we want to participate in. So as we're watching these, and we're looking for these moves, we're looking for the next setup, the currents are shifting. If we're positioned right, the current is going to get you where you need to go. If you're not, unfortunately, you may drown. And I'm going to tell you about 2 new rapidly developing currents and how I'm planning on taking advantage of them, how we're trying to time our way into the best reward versus the smallest risk to give us the best return on risk possible in these 2 new currents. By the end of this briefing, you'll know how the currents are moving, how the strategy will benefit you over the next few weeks, but really not just the weeks. We're talking months, quarters, years, and maybe decades, because this pattern and these methods do not change. They do not alter over time as far as how to use those. They do the current shift, but how to identify the currents and where money moves doesn't. So there's some key things we're going to get to as we go through step by step. And one of the questions I'd ask you, how have you defended against the sell-off? What have you done already, or what are you going to do from this point forward if we have another correction? Do you think the bottom's been put in, or do you think there might be more troubled, rough waters ahead? That's the question I want you to ask yourself in this market. With everything that's going on, what do you think? So this is one of the big inflation hedges that we're seeing. This is a new current. We've seen the current kick in, cross through here, and this is an inflation hedge. We have multiple commodity hedges and multiple commodity plays. This is the inflation hedge, obviously with gold. As we're pushing through here, yes, we're at this pinnacle. So this is not where we're getting in, but we know that the current is still strong. So what we're looking for is we're looking for a subcurrent to get us back into that trade and benefit from this massive return. And as we're watching these things, we're also looking for this next current, which is this one. This is a $6 trillion a day market. Now, does anyone know what the New York Stock Exchange trades per day? Just curious. If we're looking at this, the New York Stock Exchange average total dollars traded in the market, you might see 600 billion on a crazy day, right? This current trend right now, this this new current that's establishing trades 6 trillion a day. It does every day what the New York Stock Exchange does in a quarter as far as trading volume. So this current is so much larger than what we're seeing in equities. We need to be aware of these currents. And we've seen a lot of movement in here, especially over the last couple of weeks. Notional value, yes. So as we're looking at the notional value, this is what we're saying. The notional value traded in equities is about 1% of what trades in the currencies market. So we're going to talk about that and how we benefit from that and what we look at in conjunction with those moves. And what we're going to find is that there's opportunities to be able to trade, protect, defend, set up, and opportunities are always there. We do not have to be waiting. And because if we wait, what do we feel? I mean, these are just some of the headlines. These are stuff from the internet, stuff from online. Obviously, we have the worst stock crash done by banks. Does that sound familiar? Because if we're talking about the 1920s, we're not talking about just recently. We're not talking about too big to fail. This stuff repeats. You can see we have the worst crash done by banks. Over here, bailout plan. Well, that was also banks. What do you know? Oh, the one-year plague. Well, what about the dot-com bubble burst? What about the tariffs right now? Like was shown to you earlier, I sent out that email, that newsletter, November 20th, not January, not February, not when the tariffs were there, but when the tariffs were threatened and how that was setting us up and what we should have expected. And we've seen it continue. Boeing yesterday. Anyone in Boeing? What are you doing with that? If China cancels 8,300 planes, what are you doing? I'm asking the question, what are you doing to protect yourself? Because these are the news items. And as we see the next news item, and it's even more dramatic over the last couple of weeks, certainly this year, that we see this kind of feels like the ride, right? I can retire. Oh, I can't retire. I can retire. Oh, I can't retire. I can retire. Oh, I can't retire. And we see it going up and down and up and down and up and down, and more net down than up. So if we're so used to this idea, and I like what Garrett said, the 60-40 doesn't work. Does anyone know what the 60-40 reference is? Does everybody know what the 60-40 reference is? Historically speaking, if we're talking about 60-40, if you're young enough, you should be putting 60% into equities and 40% into bonds. And then that flips, and we should be going to 60% bonds into 40% equities as a retiree or someone that's in trying to protect more than grow their account. But even bonds got knocked down. Even bonds erased in the single largest bearish week since 1982. Single largest bearish week since 1982. So as we're looking at these markets, my question again, are you riding this emotional roller coaster? Are you feeling anxious with what is going on in this market? If you do, totally understandable. If you understand how the shifts move and the currents change, they move from one thing to the next, then it's not going to be this panic. It's going to be, hey, we're safe, we're fine, we're prepared. We're going to watch for this next move. We're going to be able to see the next opportunity. And so that's what it comes down to. But things have changed over the years. It used to be, yes, what do they tell you? Put your money into the stock market. It will always recover. But the game has changed. Compare the days of Lou Gehrig and the Babe, right? To now. Is baseball different? Theoretically, it's the same game. Theoretically, it's all the same. But has it changed? And I'm not a big sports guy, but I think this is a great analogy. So just get long GameStop. That's a Not a great retirement strategy. Get long GameStop. That's my strategy, right? But the game's changed. It's changed dramatically. What we once did in the past, well, it was baseball, it's changed dramatically, but what's changed in retirement? What is altered? Well, if you go with an advisor, your money's tied up. If you go with an advisor, and I hate to say this, but most advisors are self-serving. They charge sucker fees. You're a prisoner to the S&P 500, and they have a very passive role in how to defend and trade your account. With what I'm going to show you now, the real opportunity is to have full freedom. Your interests first. You, not me, not an advisor, you. Your interests are first. Minimize fees because you're only trading brokerage commissions. Get a profit in all markets, up, down, sideways, and you have it take an active role. Now, I'm going to tell you a little story. And this story is from a very handsome young man, which is me. I was handsome when I was younger, not now. Totally accepting that. I was once, as Kramer says, I was once one of the beautiful ones. So when we're looking at the market and we're watching this, I was part of the financial advisor world. I won't name the company, but I was hired and brought into this company, and we were sitting in there. We're supposed to get on the phones. We're calling all the people. We're doing the things. We got pulled into a meeting, and the guy that was the VP over our department pulled us into a meeting, and this is literally, well, a summation of what he said. He said, stop trading your people's accounts. Put them into one of our highest paying, meaning us, highest paying Fidelity funds, and get back on the phone. Stop trading their accounts, put them in one of the highest commissioned Fidelity funds, and get back on the phones. I knew at that moment that this is not what I signed up for. I got pulled into a meeting and they said, hey, I guess they had a tendency to try to do the scared straight, get loyal commitment, get you afraid for your job. So I walked into the meeting, he told us, stop trading their accounts and get back on the phones. By the end of the week, apparently they were going through everybody and doing this. They pulled me into the meeting. I had the VP there, and I looked over and the HR director was in the seat next to him. And I thought, this is interesting. And he said, hey, you're making us a little nervous because you're not spending the time on the phones here. You're talking to your clients about other things rather than this. You're making phone calls to your clients even during lunch breaks. And I just don't know. I stayed up all night. I couldn't sleep. Because this is literally what he's telling me. I couldn't sleep because I didn't know if this is going to work to have you here. And apparently he'd use that kind of a line to scare people to say, well, I'll do whatever you want. And I said, well, here's the problem. You hired me because of my clientele and my database. You hired me because of how well I take care of these business owners. And so, yeah, you're right. It probably won't work. Where do I leave my stuff? And I looked over, corner of the eye, and the HR director had this uncomfortable smirk. Apparently no one liked that. And they were always bending to the threat and getting in line. I couldn't do it. I didn't like it. I wasn't willing to just shove them into something that paid me the most and the company the most and not actually help them do it. And that's the reason why we use these new rules. This is the reason we tore up the old rules and said, hey, there's opportunities here. And even as we're looking at this, big growth is exciting, but consistent growth, avoiding drawdowns, wins over time. As we're looking at this and we're watching this and we see this big pullback, my question for you, if it stops right here, maybe this is the bottom. We don't know yet. We're going to watch the currents and we're going to know ahead of time. But even if this was the bottom, an average return in the US equity market over time, what is the average yearly gain? Does anybody know that number? Average yearly gain in the stock market. What is the average yearly gain? About 10%, 8%, 12%, 10%. So if we're doing this at 10%, just recovering, how much does it take to recover from a 20% loss? It takes 12% recovery. So it will take 2 years, or sorry, 23% recovery. It'll take 2 years and some just to get back to break even. But the thing is, we're continuing to slowly grow. And it may not, you might say, oh, that's so boring. I'm only going to make 2.5% while the market sells off 20. There's two things to pay attention to. There's a 23% differential there. Number one. Number two, while the market's recovering, we are still climbing. Well, and let's throw in a third. Number three, is it exciting to go to the bank or is it boring to go to the bank? We are just going and making deposits. That's the game. It should be boring. I want your retirement to be boring. The excitement over the last 6 weeks probably was more adrenaline and fear rather than excitement, hooray. And so I don't want you to, excitement is fun, right? Or scary. But the fact is, we don't want your retirement to be exciting. We want it to be consistent and boring. And it doesn't have to be retirement. As you're getting to the point where you're saying, look, I just don't want to deal with this volatility. I'm early on. I just want to grow my account. It takes a lot longer to recover here. And the fact is, you can't fight the current. I'm an excellent swimmer. And I'm not saying that to brag. I've just swam since I was 12. I've swam competitively. I placed at region. I placed at state. And so I'm a really good swimmer. I still swim about 3 times a week now. And I know, even as a good swimmer, I cannot fight the current. And you might say, no, but I'm an excellent swimmer. I am such a good trader. I know how to do everything. I know how to fight the current. And you might think, I am the proverbial salmon. I am going to swim upstream. I'm going to make it to where I'm going to be. And I am the king of this market. I am the super salmon. The problem is, even if you are an excellent swimmer, can you make it? Or will the bears eat you up? If you are a bull forever and don't see that there's currents, there's times to be bullish in some areas and bearish in the others. If you think, even if you think you can outswim, can you outbeat the bears? That's the question. And what about the other things? What about the other risks? I like the comment, excitement over the last week has been putrefying, right? What about the other risks? Even if you're a good swimmer, there's rocks, there's eddies, there's undercurrents, there's traditional managers, managers. What about tweets? Are you ready for those? Can you even see those? The current flows over those. Those are obstructions that we may not see coming, but the current flows over those. The current isn't changed by one tweet. The current isn't changed by whether your traditional manager is sucking up everything in their own interests. The current is there. And if the current changes, then those will be all the same obstructions and hidden rocks and eddies and undertows. Those are also hidden in there as well. So as we're watching these moves, we will survive better if we go with the current. Now you'll notice I've got go with the current. I've been river rafting. I've river rafted the Salmon River. And even when you are riding with the current, are there still risks? I like it. Salmon swim up the stream and they just die. Whether they get eaten by a bear or just die of exhaustion, right? As we're looking at this and we're watching this, the fact is there's still risks. When we go with the current, what are we doing? We're having the odds best in our favor, but we're still going to have the safeties. We're still going to wear life jackets. We're just going to put on the helmets because there's still rocks. There are times when someone goes overboard. We had that happen multiple times when I rafted the Salmon River. So we're still going to do those things that are safe. But what we're looking at is we're looking for these 4 major currents. Now, I've got one missing here because I want to highlight the extreme differences. These are some of the extremes. The middle one, the candles there in the middle is the S&P. So we want to buy the strong, but we also want to sell the weak, not just exit the weak, sell the weak. There are times we're going to take bearish trades. And as we're looking at this, and we look at the bearish trades and we look at the opportunities there, this is what we're looking for. Okay. So while we're looking at this, we're looking for the moves. We are looking for these changes and these shifts. And there's an old adage, the rising tide lifts all boats. But it's not the boats. It's not even the water. The moon causes the tides to change. We need to see where things are going. And an anchor can hold the boats to the ground. And if you have a hole in your boat, well, there's no rising tide that lifted anyway. The fact is, money doesn't go away. When money moves away from equities, it has to move somewhere first. So these are my 4 major area. Oops, sorry. These are my 4 major areas: stocks, currencies, commodities, and bonds. And you say inside stocks, we have sectors, we have ETFs, individual stocks. Under currencies, we have the US dollar, the euro. Money market is a cash position. And as we're looking at this, cash in your trading account. If you go into cash, depending on where your account is, Cash is a long US dollar position. If you're in Europe, cash is a long euro position. So going out of all the markets, you are unleveraged into your domicile currency. Bonds could be long-term government bonds, short-term government bonds, corporate bonds, and those government bonds will include treasuries and municipalities. But there's secret sauce in there. We also use utilities as a fixed income or bond substitute. Now, commodities, we have gold, we have oil, we have copper, we have agriculture, and we can actually have gold going up as an inflation hedge while demand for others, oil and copper, can be dropping and agriculture can be really weak. So it's a matter of watching it. Money is not destroyed, it's moved. $7 trillion is what they estimated it was lost or gained in that move. The fact is, if you can't lose it without it going somewhere, we can claim that equity has lost $7 trillion in a month. It went somewhere. It always goes somewhere. It just doesn't disappear. Money is created by the central banks, but money is not destroyed. Its value might be destroyed, but it is not destroyed. It's always a movement. It changes from one instrument to another instrument. And sometimes that goes from stocks into cash. Sometimes it goes directly from stocks into bonds. Sometimes there's a flight to inflation safety, like stocks into gold. We're moving money. It never goes away. So when the market is selling off, you can say, I've lost this. I don't know what to do next. Well, the fact is it moves somewhere. Can we see where that's at? And the deep currents are going to tell us where there's going to go. There's ways to read the deep currents or movements of the money because it changes from one to the other, hand to hand, market to market, shifting to these major investment instruments or vehicles when we talk about equities, commodities, bonds, and US dollar. So as we're watching these, here's a couple of them. I'm going to walk you through. And this is going to give you some structure that you can work it. And this is history. History doesn't always repeat, but it usually rhymes. One of my favorite quotes, and we'll come back to that later. The fact is, a yields versus commodities has a positive current, which means as treasury yields rise, generally speaking, commodities are rising as well. And you see the bottom here, this is the correlation between treasury yields and DBC, which is the commodity ETF, have a positive correlation over years, over decades. When those decouple, we need to find the right opportunity to shift. But when they're in line, when they're correlated, we're going to watch yields to trade commodities. Might seem a little bit off, but that's what we're doing, which means we're going to see a negative or inverse. For those of you at TheoTrade, you saw me explain bonds on Wednesday. We're going to see a negative or inverse with bonds. So bond prices are climbing, the demand for bonds and safety are going up, and that's generally an indication that commodities are going down and demand is sliding. We're going into safety and avoiding risk. And again, this is off of a long period, multiple years. These are, understand that they're positively correlated for 4 or 5, 6, 7 years in a row. And then you have these breaks, and notice where the breaks happen. 2008, this correlation happens at these extreme shifts. Over here, a lot of people don't talk about 2013. 2013 saw a 30% correction in the Russell, a 15% correction in the S&P. So we always talk about biggest bull run ever. Just because we didn't get to 20% on the S&P doesn't mean we didn't have a massive correction there. But we saw that. We saw the decoupling or the break of the correlation and the ability to move away. So we have an inflation, dual inflation is what I call it, comparing bonds to commodities and looking for commodities versus commodity treasury price ratio. That commodity price treasury ratio is going to give us lots of indication. When it's climbing, it's inflationary. When it's falling, it's deflationary, disinflation. And we're going to see that move in a way that says when they're rising, prices are going up, and that would include commodities, inflationary. And when they peak out down here, and this is the S&P in the background here, but the blue line's commodities. As we're looking at this, when it peaks out and starts to sell off aggressively, that's almost the peak for commodities. And commodities end up selling and selling and selling. And commodities end up dropping from 27 down to 17. We're talking about a 50% correction in commodity prices that we saw in this deflationary area. And I know there's economists out there right now, they're yelling at the screen saying, it's not deflation, it's disinflation. I don't care. Deflation, disinflation, whatever you want to call it. The fact is commodity prices fell, and that was a huge opportunity for us. Bonds and equities normally in the short term have an inverse or negative current. Bonds climb, equities drop. Equities climb, bonds drop. But I always tell you, there's more to it. It's more of a long-term double helix. You can see here's the long term. You go in here and you say, aha, see, they rise and fall and rise and fall. And if I were to go through there and I were to define that line in between, if we were just kind of draw the linear regression between these two rising and falling lines, bonds versus equities, that would be your inflation rate. So bonds and equities have a tendency to rise and fall together at the rate of inflation. We know right now they both dropped. So short term, intraday, 1 day, 2 day, they have a tendency to go opposite directions, but in the long term, they're going to move together because they're more representative of the entire US economy, inflation, disinflation type of behaviors. Let me show you another one here. The dollar's purchasing power versus commodities. Now, this is the dollar. Please understand the dollar, when we measure the dollar index is the dollar versus the basket of currencies. So if we look at gold going up, that means the dollar is going down in relationship to gold. But the dollar index could be going up against multiple currencies while gold could be going up as well. That tells you we have global inflation, but the dollar has less inflation. And I get into the details on that in the deep currents. So for those of you that are going to join me in deep currents, you'll see how we time that and how we read whether it's the dollar versus other currencies or dollar versus commodities or the dollar versus equities on whether the dollar is truly deflating or inflating in value. So we're watching this, we're looking at these changes, and these have lasted decades, and they're not just a short-term view, but it's a matter of timing these in the shorter currents. So here's a quick commodity table, or a table comparing the treasury yields versus commodities are usually a positive current, bonds versus equities are usually a negative current, commodities versus US dollar are generally negative, US dollar versus bonds are positive, and that's money flow into the US. Doesn't happen always, but if there's money flowing into the US from overseas, not like it's doing now, then we see the dollar strengthen while bonds are going higher because the people are selling their currency, buying US dollars and buying bonds as a safety in the US. Not what's going on. That's what's going on now. And that's actually not a fearful thing. When those correlations break, that's the opportunity, the big opportunity. And equities versus commodities are generally to move together and positive. What this means, as John J. Murphy says, great author, great technician, what this means for us as traders and investors is no longer possible to study any financial market in isolation. You cannot just be an equity trader. If you have been just an equity trader, I ask you, how have you done in this last 3 months? Were you prepared? Did you know? Did you set up? Did you protect? Or are you looking to try to recover? Recovery is not easy. We do not want to always have to be recovering in these type of markets. We want to survive and thrive in these markets. And so, as I said, my favorite quote from Mark Twain, history never repeats itself, but it does often rhyme. And I've heard that as history doesn't usually repeat itself, but the quote that I found on the interwebs is history never repeats itself, but it does often rhyme. So what do we do? What do we do? To hedge out the risk, we rotate when the currents change. To hedge out the risk, we rotate into the strong currents, out of the weak ones, and potentially even short and leverage into bearish positions on the weak currents. Going back to that slide I shared at the very beginning. At the very beginning, we showed you this, showing you where the crosses occurred. We want to be out of equities here, up at the top. We want to be going short and bearish equities when we cross through that line and benefiting from not just the bullish, but we saw that peak kick in all the way up when the S&P 500 was at 600. The SPY was at 600. And then it dropped to 480. So we would have been out there and potentially going in short at 580, benefiting from all these moves to the downside. The dollar index, remember, it's the dollar versus a basket of currencies. It's not the dollar versus equities, it's not the dollar versus gold. So when people say the dollar is strong or the dollar is weak, it's compared to other currencies. In economics, we call that purchasing power parity, but that's just fun to say because it's an alliteration. When the dollar is rising compared to other currencies, it means the dollar can buy more stuff on a global stage. Why is that important to us right now? Why is the fact that the dollar peaked out and has erased everything it gained and dropped through the last low, why is that important to us? It means the dollar can't buy stuff, And then you add on the tariffs and the dollar really can't buy stuff. If we were truly an exporting country, this might be great, but we're not. We're a net import country. It is inflationary, as Ron says. We're seeing the pressure put on the dollar on a global scale is facing more inflation than all the other currencies. And for those of you that follow the markets and look at currencies, today, the European Central Bank cut rates. The US hinted at it might consider it yesterday from Jay Powell. And what do we get? You'd think, oh, if they're cutting rates, that would weaken the euro. We're maybe going to cut rates, but we'll do it later. Maybe that should keep the dollar stable. We should have seen the dollar gain relative to the euro. And the reality is the euro climbed. It shot higher overnight, fell back to support, shot higher. It's defending and moving higher, even though they cut rates. Interesting. Yeah, money buys less. So as we look at this is over here, we've got commodities. So looking at the commodities have given us bullish. This is gold. We compare gold, but we also look at general commodities. We also look at oil alone. Gold alone, oil alone, and general commodities together to find whether we're seeing true inflation or we should be hedging and protecting. We were told to buy gold at 2,800. Brandon and I talked about this really in December and then January. And we said 3,000 could be the target. We went to 3,000 and then we pulled back and shot higher to 3,245 just a couple of days ago. And we're looking at this as maybe being the top, but we're going to let it breathe out. We're going to watch the current. The current has a tendency to ebb and flow in the short term, but play with the longer term trend for a very, very long time. Now the ZN, you see we crossed down, that's bonds, bond prices fell. And right here, this was the biggest weekly sell-off in 40 years, 43 years. Huge sell-off, but we recovered. And the people in deep currents, you already know what I tell you. I said, this bounce, it's going to go higher, but we're not going to hold it over the weekend. We're going to protect, exit TLT, exit the bonds ahead of the weekend, last weekend. And we're not going to step in ahead of the weekend in case we get some new craziness, but it should bounce and go higher, which we did. So we're watching the currents. We're seeing what it's done. This big pullback, it's still looking for bullishness. It's still trying to be bullish, and we were looking at that right through there. So the currents have set us up for a long time frame. What can you do if your 401k is trapped? Well, one, you can do self-directed retirement. If it's 401k, you can ask them to reallocate. And you want to be able to reallocate into things that are in the newest, most recent currents. I want to say current, but that's redundant. But is it? No, it's not. We're looking at the most recent or actual meaning now, currents. And so we're watching this. You can see I've got the 4 major currents through here. Do you see that despite everything that's gone on, despite what we've seen, can you see where the shift occurred? We already looked at the quadrant showing all 4. Can you see where it is here? Can you see when they're crossing each other? When the currents cross each other, when you see that they're crossing through here, this is telling us, hey, shift. The money is shifting. And really from this view going back 6 months ago, we've seen gold gain 21% while equity has dropped 20%, as we've talked about from 6 months ago. The difference there is 40%. The difference between the top performing and the bottom performing is 40%. But we can benefit from trading the bullish and also being bearish and trading the bearish. And yes, your IRA, if they're self-directed, whether Roth or traditional, or your retirement funds, if you have that in self-directed, you have the ability to trade long puts, or we can do inverse unleveraged ETFs. I don't hold long-term leveraged ETFs on these, but we do long stocks, we do long calls, we do things that are basic, and we give you both a stock trade and an alternative trade. Whether you're larger account or smaller account, we give you all of that as part of the advisory in deep current. So we let you know, here's the trade if you have your large account, if you're in an IRA, if you're doing it this way. Here's for smaller accounts, still the same trade, still the same concept, still the same current, but you can do it with smaller accounts, smaller leverage, smaller risk. And so you can balance that out. So as we're looking at those things, we're watching this, we're looking at it and saying, but wait, is that driving in the rear view mirror? I always liked what Warren Buffett said. In the business world, the rear view mirror is always clearer than the windshield, which is true. In the business world, it's always easy to look behind you and say, That's what happened. It's like I said. The fact is, in fact, let me show you. I've got this right through here. This came through to my email, and I can even show you. Hang on, I got to make sure I hide the name. This is a friend. Whoops. Can I? Oh, come on, paper. There we go. It's not showing it. There we go. That Zoom is trying to hide that from you. It doesn't want you to see. It's part of the conspiracy. So this is a email I got printed off. I'm just gonna have to read it to you because it's obviously not going to show it to you. And in this email, I have a friend that started an RIA a year and a half ago. And he said, Blake, will you let us manage your funds? And I say, I self-direct. And he said, we're starting an RIA. We just want to be able to have some money. We want to get some traction. I said, okay. So I sent him $8,000, which he's lost a bunch of. But I sent him $8,000 to manage. So because of that, I get these letters. And so on these letters, what it came down to is he said, the momentum of emotions from tariffs continue to create magnified volatility, which is drowning out material economic data. Now, this is dated April 4. So remember, I sent a newsletter back in November. He's looking in the rearview mirror, which is super clear now. On April 4th, he sends a letter saying, hey, we're readjusting all of our allocations. We're removing risk from you. April 4th. How good is it he's removing risk and volatility 3 months after the tariffs really were kicking in? And the other thing at the very bottom, he says, markets always recover. This will be no different. It is simply a matter of time. What does that sound like to you? Can I transcribe it a little bit? Not transcribe it. Transpose it just a little bit. Markets always recover. This will be no different. It is simply a matter of time. What is he saying? He says, yes, you got hurt, but don't worry, buy and hold, just like Chris says. He's doing the exact same method I told you about earlier, except now I have documented proof. I sent you the email in November. He sends it April 4th, December, January, February, March, April, 5 months, 4.5 months after, and saying, buy and hold, don't worry, hang on to it. It'll recover sometime. Markets will always recover. Okay. Is that what you want to do? Yeah, I'll give you this chart later. I'll share this quad. If you're interested in this quad, I can share it with you. Okay. What's wrong here? So as we're looking at these shifts, we're looking at the changes, we're looking at the opportunities in the markets, we're going to look for these and we're going to drill down into them. We're going to find where they're setting up and we're going to apply that. We're going to apply application of sailing on the current. We're going to benefit by floating in the raft with our helmets, with our life jackets, because we're going to protect ourselves. But just these same currents in that pullback said, hey, maybe just go to the sidelines, avoid an 8% down. In the climb, create a 14% move. So the currents told us 8% down, 14% move. Now you'll notice I'm not trying to hit the peak. I'm trying to hit where the crossover occurred. I'm not trying to hit the low. I'm hitting the crossover. So even though the chart the arrow is not lined up the same, the 8% is from the crossover down. This over here is a cross up. So when the NASDAQ is climbing, there's an opportunity to make 14% with leverage. There's opportunity to make 14% with collecting premium. There's opportunity to make money on the way down. So when we see it reverse, we were told to start going short back here, and the market dropped 23% on the NDX from the time it crossed and dropped. And it went as deep as 28%, 27 point some odd, as Garrett said, 27. It's 27 and some change. So I rounded to 28. So from peak to trough is 28. This gave us 23% of that move. And we're not really being told, despite this bounce, despite the climb here, we're not being told the current has shifted. So if you don't think that the bottom is in, there's more opportunities to be bearish and go with the current. We don't have to be afraid of this. By the way, the NASDAQ NDX fell 38% in 2022 and only to recover and run up 50% in 2023, and another 40% in 2024. But as we're watching those, the opportunity was up, down. Even those swings were huge. And there's opportunities to defend that. So as we're watching this, this is just telling us the shift. This is not the timing of the trends. Yes, these are the moving averages. The longer terms are 15,200. That's what the institutions like to use. I have no problem showing you what that is. That's not the timing of the trade. It's also not the alerts that I send out. Same thing as what we're seeing in the dollar index. The dollar index down 5%, up 7%, down 8%. That dollar index down 8%, like you see here at the bottom, is equivalent to a 20% move in equities because there's about a 2.5 ratio to equities versus the US dollar. And against individual equities, it's 5-to-1 ratio. So that you're going to see stocks when the dollar signals that the dollar is weakening, equity should have risen, should have climbed 20%, but the current didn't tell us to go long equities. If the dollar's purchasing power is going down, that should mean that prices of assets are inflating. If it doesn't, that tells us not to go with the bullish current and that we have more downside. There is more to come. There is a much bigger current that's going on, and we shouldn't be buying this just because equities are starting to recover. The fact is the dollar is still weakening, and so therefore the dollar's purchasing power is lower. If equities are still falling, if the dollar bounces, then equities are going to sell lower. Am I breaking up? Let me know. All right. How do we stay ahead? What do we do? What are we looking for? As we're watching this, we're still clear. For any of you, if you have any problems with the audio, Brian, one thing I'd do is to your left there, there's a little thing that says low latency. Turn that off. That'll help out. That should clear it out. Okay. And hit refresh of the page and then turn off your low latency. So the application of the sailing again, gold gained 18%, fell 3% and gained 22% just since December and still climbing as of 2 days ago. As we're watching this continue to push, there's opportunities in all these. And the fact is we're not just simply trading this direction. We're not just trading the crossovers and that's it. CLT or bonds gained 10%, dropped 9% and climbed again before dropping, like I said, the biggest weekly drop in 43 years. So as we're watching these moves, we're seeing the shift higher and lower, lower and higher. As we're looking at this move and we're seeing this pullback, is this the time to go short bonds or is it time to go long? We're still being told to be stepping in bullish trades and bonds, but we have to do it precisely. We do want to time this in the right instruments. That may not be a bond ETF. It may not be a direct bond. It might be a municipality. There's municipal ETFs that we want to step into as a safety. There are utilities as a substitute to fixed income, but these are just the currents. We're going to trade inside of those and have better opportunities. If we know the index has a tendency to go 2.5 times what we expect from what the dollar did, then individual equities, when we pick the right equity in the right sector, has the potential to go 5 times what the dollar did. So if the dollar loses 2%, there's going to be equities that we can make 10% on in the same swing. It's all a matter of knowing where the money is moving. It's always moving somewhere. There's no such thing as everything losing together. It doesn't exist. The dollar can't lose while bonds are losing, while equities are losing and commodities are losing. That does not exist. And if it does, you see, well, that looks like it is. That means it was going into a different currency. So when I say currency, it doesn't mean just go into cash. We do play euro trades. We will play those as well. We'll trade the yen if it's the right time. So we're looking at this, we're watching these moves, and we've seen these massive moves. Again, $500 billion has moved into equities and fixed income, or sorry, bonds and fixed income in these two swings. And we're talking again, the $6 trillion move that is going into currencies. In bullish markets, this deep currents methodology wins. Okay, we make money. It's great. So even if the equity market is climbing, we're going to buy the equity market. And we're also going to look at selling weak stuff and buying that. So when the equities like the NASDAQ and was climbing in 2023 and recovering, you would have netted out 23% over 2.5 years based off that current, or about 9.5 to 11%, depending on where you timed it, about 9% per year on average. But by going into this and saying, I'm buying the strong, I'm selling the weak, I'm going bearish, buying puts, selling short, buying inverse unleveraged ETFs in that area, that same deep currents, when I established this and built this out, for those of you that went to the investor conference in Florida, you saw this. This is what we were setting up and this is what we showed you. In the same time that the NASDAQ gained 9% per year, in the same time frame, we did 34% per year in that. So even in bullish markets, it's not just a defensive methodology. And again, in bearish markets, This is where we thrive. Not thrive just because we avoided the loss, because when we see these pullbacks, what do we see? What happens? It takes time to recover. So as we're looking at this, what's the biggest secret? Well, for me, the biggest secret is this. You don't have to be perfect about it. The biggest secret is those currents move over time. Those currents set up over time. We see the currents coming. We can correlate it to news. We can correlate it to the things we're seeing in the market. We can correlate it to individual stocks. We can correlate it to a tweet. We can correlate it to the Fed. It doesn't matter. We see the currents shifting, and it takes time for those currents to shift and change directions. So you don't have to be perfect. You just have to be following the best and strongest trends up and be participating in the weakest and falling sectors and currents down. That's what we're looking for. We don't have to be perfect. And the fact is, it's easier to reach your retirement goals, or maybe it's your travel fund. Maybe you have money that you say, this is so I can travel. Maybe it's so I can pay off my house. Maybe it's so I can buy a second house. Maybe it is for retirement. And the fact is, it's easier to reach your retirement goals by reducing portfolio volatility than anything else. You can make 12% a year, or historic 10% a year, and with the 2% drawdown every other year, and it still outperforms a market that's doing 20% a year. You say, but I want to go with the 20%. If you're leaning into those equities and you deal with a 50 to 60% correction, what do we see? What's the exposure? And I see the questions. We'll get to those. Just remember, I got to get through a couple more things before we get to the questions. But if the fact is, if you see a 50, 60% drawdown, how long does it take to get back up to positive? I saw a tweet the other day that someone said, if you lose 10% and make 10%, you're still down. And it's so funny because people that don't know math said, that's not true. They don't understand. The fact is, it is true. If you lose 10% and make 10%, you're down 1%. So as we're looking at this, if you lose 50% of your account, like you did in 2008, or 66%, 67%. In 2007, 2009, we were told to be long gold and commodities and short equities in the dollar. What would have happened to that? You would not have experienced a 67% drawdown. You would have gained 22% during those same 2 years. And if you did experience a 67% drawdown, how long would it take you to get to break even? On average, how long does it take you to get to break even? Well, if you draw down 67%, from that moment, you have to make 200% to get to break even. So even on a 10% average per year, are you going to wait 20 years? We didn't have to wait 20 years, but are you? Because that's what it was defining. It started the biggest bull run in history, and it still took 7 years to break even. But in that break even, we're still climbing. So remember, their drop 67, the net difference was 89%. So then that 7 years that it took to get to break even, we're still climbing, we're outpacing, we're performing. And so you're never catching us. Those that don't experience the drawdown, in fact, profit during that drawdown, don't experience that, you will never catch them. It's just not possible. Even if you're looking for those 20% returns, you're not going to see it. So do you remember when? Well, let me ask the question. Do you remember when, or what were you told 10, 15 years ago? How much did you need to retire? What were you told to have your debts paid off, and how much in your retirement account? What were you told? What's the dollar amount you were told to have in your retirement? $1 million. Henry, you nailed it. That's exactly what we're being told. We were being told you should have $1 million in your retirement account. At least 1 million, right? At least. Okay. 1 million or more. Do you know what that number is now? The expected. And I think that's much better as you said, 10 times is the better one. Henry says 3 million. Yeah. The minimum, absolute minimum to survive, if you still get your Social Security, they say is 1.5. But yes, the number they're telling you now is you ought to have over $2 to $3 million. And that's again before the future inflation. We're expected to have 1 million. Now you have to have 2, 3, and that's if we don't see even more inflation. So if you don't know this secret, the question again, are you ready for retirement? Do you have a plan? What have you done so far? Even if you do have a plan, have you executed on that plan? Have you avoided a drawdown this quarter? If you haven't, there's some things that we need to get adjusted. Yeah, and even after tariffs, even more inflation, right? Even more cost, even more problems. Alexander Elder, a psychologist that loves to study traders and investors, he says beginners focus on analysis, but professionals operate in a three-dimensional space. They're aware of trading psychology, their own feelings, and the mass psychology of the market. And I would say we don't even have to get into the psychology. I don't have to get in their brains. That's a scary place. My brain's scary. I wouldn't want to be in there. So I try to avoid it all I can. No, the fact is the currents are going to tell you which trading psychology, mass psychology of the market, their own personal fear and excitement are going to play into this, and the analysis of the market. So we're looking at the price and it's telling us after the fact, or as it's developing, what the next current is and where that psychology is going to impact the market. So the biggest threats to your retirement, and there you may think of another one. If you see another one, throw one in there. We've identified the 4 biggest threats to your retirement are outliving your income, medical expenses, a downturn in the market, and inflation. If you are healthy, you're going to outlive your income. Well, that becomes a bigger threat. Maybe you won't. Not if you do it right. Not if you save enough money. Not if you do the right thing and you grow your account when the rest of the market's selling off. But the fact is, these two are kind of interchangeable. You might outlive your income because you're healthy, but then you didn't have medical expense, so you're outliving your income. You might have a lot of medical expenses, so maybe that's the thing. You might be able to outlive your income, or your income will outlive you. If you have a lot of medical expense, well, there goes your income. The fact is, we're dealing with the downturn in the market, what is arguably hidden inflation of double digits, and we're dealing with possibly all 4. We've had some of the biggest medical expenses in history in the last 5 years. And so where are you at? Do you have ways to defend against this? If you do not have an adaptive, personalized plan to retire comfortably, are you ready? Are you ready for retirement? Even if you're younger, can you grow your account to outpace all these? The fact is, if you are younger, if you are in your 30s, 20s, your retirement will need to be 10 million. Who knows what it'll have to be by the time you get to retirement. But the fact is, you're probably going to live to 105, 110, 150, 120 because the longevity is increasing faster and faster. Are you ready to defend against that? So we go back here and we say, where are the deep currents shifting? I already showed you that we saw that big shift here. We're starting to see a little shift down through here, and we're setting up for the next current. Gold is probably a little overinflated. We need that to breathe out before we step in or see if it changes the current. There's opportunities. The largest VIX spike since 2008 financial crisis happened in 2024. And during that time frame, a lot of people weren't paying attention. That time frame, we saw a 10 to 15% drawback in equity indexes. We were prepared for it. We were more than safe. And then we see it happen again. So there's that VIX spike. And during that performance, in just the 3 weeks around that, the VIX spike, equity indexes fell 9.7% and individual stocks fell 25%. Our portfolio, again, outperformed that volatility spike. We can take it to the next one. What about the volatility spike of this last week? We already know this. I've already shown you. The fact is the volatility spiked again. Highest level since this one. As far as close prices, absolutely the highest level, including and surpassing 2008. But as far as the highest points, that VIX spike here and the VIX spike here, volatility, fear, uncertainty, that VIX spike, we were prepared and we outperformed. In that 3 weeks, equities fell 21, or some equities fell 43%. The equity indexes fell 21.6%. And again, we outperformed. We stayed positive. But that's the whole point. This entire thing is about defending, protecting, benefiting, and trading the right currents. And we've shown it. I mean, we bring the receipts. I share every time I make a new trade. I share one. I let you know ahead of time, so we have hours as much as we can to trade those. And we share you the portfolio every single time I make a change. We reload it and we share it again, and so you can track all the performance all the way back.
Blake, that was I'm here.
Thank you.
I made it. That was awesome.
Thanks.
Now, look, I think you just hit the nail on the head. One of the key things, somebody asked a really good question. They said, how is the market going up 10% when the economy, the underlying economy, is 2.5%? And you hit it on inflation, you hit it on debasement, And you continue to see just this environment and what you're seeing right now. What's so important, guys, everyone here, like these two current shifts that are underway, it's time to get moving on this. And I'm really excited to bring this to you guys today. Just pay very close attention to what I'm going to show you, because the value and the opportunity is unlike anything we've ever seen before. And what we want to introduce today is deep current alerts. And look, again, do you have a plan for retirement? Do you have a plan for this market over the next 2 months, 2 years, 20 years? That's what Deep Currents is about. That's what Blake is bringing you today, and absolutely throwing everything at you today, everything that you are going to need in the next 6 weeks to just get moving. This includes, for 1997, you're going to get so many benefits. The Deep Currents Mastermind, this is a 12-week mastermind with a detailed plan on how to spot and follow the currents, and that starts May 6th, 3 p.m. This is a $3,000 value. A lot of other benefits here. The methodology you can use to beat the market in all conditions throughout your life, and this is what's so important. He just laid this out. The S&P 500 down 10%, the NASDAQ down 20%, up on the year. And if you think back, look, I saw someone in the chat, they said, I hate to lose more than I like to win. That's exactly how I feel. If I can go back to November when Blake first started these conversations, how would you feel? How would you feel about your account right now? How would you feel about your money right now? This methodology is going to allow you to beat the markets, be comfortable in any environment, not today, not next week, but legitimately for the rest of your life as a trader. This is going to include the $100,000 Beat the Market portfolio that will launch on day one. So get involved, jump in right now. The tracking and the managing for the long term, another $2,000 value. We have weekly deep current alerts, $2,400 value. The Deep Currents coaching calls, 12 months of new and updated positions in monthly calls. The Deep Currents watch list. He has 100 instruments. So people were asking, what's the software? What are the things that he's using? He's pulling back the curtain to show you exactly what it is. All 100 plus instruments with the watch list, and that includes the updates as the market change, right? This is important because money is always moving. Blake pointed this out momentarily ago. There's no situation where everything goes down at the exact same time. And if there is, well, we probably will not be trading at that point. There's probably something much worse, but we've been through all of this before. We know how the central banks work. We know how the emergency switches come on, and we know that if those types of events transpire, that we're ready to pivot wherever the money is moving, and obviously Blake is watching that on a day-to-day basis. The one thing that's just so important about all of this, we're taking the risk off of you today. So if you're not satisfied within 30 days, email support@theotrade.com. You will get a full refund for your Deep Currents alerts. Guaranteed stipulations, there are none. There's not going to be, you need to try to, you have to read things and recite some sort of poem. No, if you want your money back, you get your money back. We want to remain friends. We want to try to find something else that you might be interested in as well. But I don't think that you're going to find something that's as comprehensive. I'm a person who loves to follow where the money is moving. Blake is absolutely miles ahead of me on some of this stuff. There's no excuses. There's no questions. There's no commentary needed. Just email us, ask for your money back. No problem. Now let's break some of this stuff down. This is the Deep Currents Mastermind. And the Deep Current Mastermind, this is a 12-week mastermind. It has detailed plans on how to spot and follow these currents. This starts on May 6th at 3 p.m. So you're going to have plenty of time to be prepped. You're going to be able to look through all the information. You're going to be able to assess if this is right for you. But there is an 8-hour bonus session that will be on a Saturday. 8 hours is a lot of time. Taking that time on the weekend to really drill down on the things that you need to know in this market while the market is closed. So this is a really important bonus session that's going to be added to this program as well. You're going to have a special room that is 24/7 for class and instructor interactions. If you have questions, Blake's probably not going to be up at 3 o'clock in the morning, but I know the way that he answers emails. He'll be on top of it to walk you through whatever your questions are, whatever you need. Go to theotrade.com/DC right now. Be one of the first people. Retail value on this, $3,000. Again, the Beat the Market portfolio is one of the coolest features of all of this. providing alerts during class, during the week, via email. It's posted to our Deep Currents room. They manage all the trades beginning to end for the duration of the course and for the entire year. This allows you to manage those long-term positions for the long term. A lot of questions we get: how much money do you need to get started? You don't need $100,000 in your account. We provide trades that are for smaller accounts. This is a great benefit. Again, theotrade.com/DC, DC for Deep Currents. And how many alerts are you going to get? 1 per week minimum. 4 per month, 52 per year, 520 alerts per decade. You want to stick around for a century, Blake will be bionic. That'll be 5,200 trades. But again, at the end of the day, we're averaging 3 to 5 alerts per week. So you're getting bonus picks, you're getting more opportunities. Because I know Blake, we trade a lot of conversations all the time talking about where money's moving. If you're a trader and you're excited and you want to have a lot of diversification and a lot of different ways to have conviction for many different trades all at once, you don't want to just do 1 trade a week. You want to have a couple. And obviously, those bonus trades are going to come in. So you might be seeing 5 a week, 20 a month, 250 per year, rather than what is guaranteed today. The coaching calls, obviously, you saw Blake in action today. This is fantastic. 12 months of new and updated positions and monthly calls, mentoring and Q&A discussing methods, the changes in the market, and the risk management. You're not going to get this from an RIA. You're not going to get this from CNBC. You're not going to get that one-on-one. That is so critical that you can be in a room talking to an expert, asking the questions that you need, and to actually see how money is moving at any given moment. This is one of the nicest things about the post-2020 environment, where we are connected no matter where you are. You're going to be a part of a community, and you're going to be able to come in, ask questions, not just of Blake and the rest of the team, but also one another, learn from one another, and be a part of that Deep Currents community. The watch list, he has, again, 100 plus instrument watch list with updates. You asked about software momentarily ago. It's just one little bonus. And these are the types of little bonuses that can make all the difference between being down 20% on the year on the NASDAQ and being up 2.3% on the year. And finally, one of the other key things, the methodology, right? Everything that you see today, right? This is value that is thousands and thousands and thousands of dollars. The methodology is the thing that I think is absolutely priceless. Knowing exactly how and when and where to go with your money, given current market positions. You're going to have the $100,000 beat the market portfolio tracked and managed for the long term, $2,000 value, weekly deep current alerts, $2,400 value, Deep Currents coaching call, 12 months of new and updated positions and monthly calls, another $1,000 value, the watch list, again, which we just talked about, and the email support, the ability to talk to us anytime you need to. We get back to emails very, very quickly. I have been told this religiously by the one of the senior leaders here. You got to answer your emails. That is part of the culture here. We get back and we speak to our community members very, very quickly. So do me a favor. Last thing, the one nice little bonus, right? Having that room, having that place where you're going to be able to go to ask questions, talk to your community, and just engage with people on a day-to-day basis, anytime, 24/7, whenever you need to. This is another $1,000 value that's added on to this, theotrade.com/DC. And again, the methodology, which is so critical. Blake just walked you through this methodology that you can use to beat the market for the rest of your life. This is absolutely priceless. And once again, taking the risk off of you today. We have 100 spots. I should have said that momentarily ago, because that's why I kept saying the website, theotrade.com/DC. This is going to be going away, this price, very quickly. We only have 100 spots today for the 30-day guarantee, plus that extra bonus of unlimited email mentoring. Total retail, $84.50. Today we're doing it for $19.95. Theotrade.com/DC. And once again, that money back guaranteed 30 days. Just call us and say, this isn't for me. We'll give your money back. We'll look for another way, something else that you might be interested in that will match your risk tolerance, match how you are as a trader. But if you are focusing on your retirement, if you are focusing on building your wealth, preserving your wealth, protecting your wealth, I assure you this is going to be the system for you. And obviously, as we said, we are always here to help. If you need help, don't ever hesitate to email us, support@theotrade.com. There's a phone number in there as well, 623-244-5657. So once again, support@theotrade.com, or call us. Write it down. Get a pen, 623-244-5657. 57. Now, Blake, I'm going to bring you back in because there are questions that people ask all the time.
Mhm.
And these are the relatively simple things that
Yeah.
are very, very common. Do you need a laptop and an internet connection? Right, it's all you need. Like if you have that, it's like if you have a phone, you have a lawyer. That's an old thing that is an advertisement here in Maryland. But the thing is here, all you need is a laptop and internet connection. Everything else you need, we are going to provide for you. This is a yearly membership to Total Theo Unlimited.
That's
We
actually DC deep
sorry.
currents, right?
Yeah, forgive me. Yeah, why are we doing that?
That's okay. Deep currents.
To deep currents. Forgive me. Hey, look, I'm Ron Burgundy. You're going to put it on the monitor. I'm going to read it, man.
Read it.
All right. So look, okay, again, we're providing multiple trades a week. One of the key things, right? We talked a little bit about some of the questions that came into the chat, and we'll talk a little bit about that. Are the trades mostly options based? That came from Jerry B.
So every time we set up a trade, I'm going to always start with the idea that we can do a long stock position or a short stock position. Now that could be if you don't feel like you can do long or short stocks, we'll do an inverse ETF if we can find those. But we also give you the alternative. So you can do the long stock, buy 100 shares, 200 shares, depending on what we're doing. But we'll also say, or you can buy the long call, or you could be the long call, what my version of in-out spread, you can buy a call and sell a call. And we do sell puts to get into positions. So I will always give you an alternative. So if you say, I can't do that, I only do long stocks, I will show you that. But if you say, nope, I like options, I want to do options, I'm going to show you that. And you get to risk manage. And so I'm actively trading both. I'll do the stock and the option position. And then your choice as to how you want to do the same strategy, the same current, same setup, but you can choose options or other. So I'm always giving you the standard and an alternative trade, every single trade. And that will allow you to position size to huge accounts and small accounts.
Simple enough. All right. So we have 100 spots today. Go to theotrade.com/DC. Let's talk about just the general risk management process, because again, you're going to have a lot of people asking questions. How do you educate people on how to manage risk in this environment? Because we just did this presentation, but again, I think that you're talking very, very succinctly about the importance of not making a bad trade, right? You said it.
Right.
I'd rather make a good trade than make a bad trade. Kind of talk a little bit about that mentality.
Yeah. So the main thing is there's going to be setups and there's going to be, since we're talking water and currents, the fact is this market, especially currently, no joke, no pun intended there, at this moment, we have sirens or mermaids in the water. And if you know the stories of the mermaids, what happens? The siren song brings you in, and what happens? Your boat's dashed across the rocks. Many sailor
Right.
lost at sea trying to go to the siren song of the super, I want to be part of this next move up in NVIDIA. I'm going to buy the bottom of this market. And the fact is, that's not the way to go. We avoid the siren song. So when you talk about, I'd rather miss a good trade than take a bad trade, I would rather stay out of that. And even when we were saying cash is a position, the fact is we were watching and the dollar was gaining. So we were also treating cash as an unleveraged long dollar position because money moves in those four places. And then when the dollar peaked out, we said, we've got to start getting out of cash. And we started moving into bonds. So one thing we're keeping safe by following the rotation into these currents. The second thing is every single trade has to give us an opportunity with a higher probability than the reward risk to make it worth our while. So if I'm getting a long position in the stock, we don't want to risk more than, I would say, 0.5% to 1%, but some of the traders are, hey, I'm willing to go as high as 5%. I'm going to always present it roughly around 1% of that portfolio. I have never seen in our portfolio trading ever seen more than 5 trades in a row go negative. And that's over thousands of trades in this methodology. So worst case scenario, theoretically, we're going to draw down 3 to 5%. We really haven't gone negative since 2023 when I created this format of this deep current. So we haven't gone negative the entire time. We did not win the 20% that the NASDAQ won last year. We made about 4 to 5%. And then when we corrected, we didn't go negative and the market went negative. So it's always about that little bit of risk versus your portfolio so the portfolio can grow. And even in the worst case scenario that suddenly we get the shock and out like we did with bonds last week, we took a 0.2% loss on that trade. Now, I don't know about you, who can handle a 0.2% loss versus a
Right.
20% loss, right? And so
Absolutely.
we're always focusing on risk as part of the whole portfolio and about each trade, and still reading the currents. We didn't want to get out, but we followed the idea that, hey, we recovered back, we need to balance. So we cut the losers off when it's appropriate. We can stay in the trades, but every trade has to meet those guidelines. Is it worth the risk for what we think will happen?
Hmm.
And is the current strong enough to maintain us through the longer time period? And sometimes it's a matter of a stop loss. Sometimes it's a matter of a long put, protective put, a married put, a structure that way. So there's other things we do, and dividends will oftentimes pay for that. So we
Okay.
it's all a big picture. There's more than one moving part to this to be able to really protect you while we're watching these markets move.
All right. Gurjot saying, I've attended several courses with Blake. He's one of the best instructors in the country. Neil S. saying, not
Well,
only does
thank you
Blake
so
provide
much.
trade alerts for a model $100,000 portfolio, but he teaches a number of techniques for setups so that someone can execute their trades based on setup criteria. Let me ask you a quick question because
Yeah.
this is one of the things that is just so much value is the ability on a monthly basis, 12 months of new updated positions in monthly calls. Talk us through that.
So there are times, and I'm going to be full transparency. I don't believe in hiding anything. So when we're sending these out, first off, I'm setting them up. I'm going into the live room. I'm usually telling them, hey, alert's coming. Then we send out the alert that goes to your email, to your text message, depending on how you set it up on our private page. And by the way, I saw that people said this is a great community. Our little group is a lot of fun. I love our little group. But I've seen our previous and current Deep Currents team, they're sharing their own ideas. I love it. They've gained the methodology. So that's the one thing you should be aware of. They've gained the methodology and are sharing with each other. And Neil's one of the, and Gurjot are participants in there that they just commented on. And they're sharing ideas that, hey, I saw this. This is what we're doing. And so when we're looking at this and we're watching the trade, we're sending out the alerts. But what will happen is that the alerts might be adjust the trade, protect the trade.
Mm-hmm.
But we've done, what was it, last year, 80 some actual trade executions. So that would have been 160 some alerts plus any adjustments we did in between. So, there's a lot of alerts, but when you really look at it, it's initial trade, maybe a couple of trades per week on average, 2 to 3 trades per week, but understand there could be 3 to 4 or 5 alerts. You don't need to rush to your computer. I'm trying to give you as much time as we can and heads up and methodology. So, oh, I need to protect here. If I see something different, I'm saying I'm not moving the stop. Normally we'd move the stop. Don't move the stop yet. We need to ride out this volatility. So the alerts are sometimes how to manage an existing position. Alerts are sometimes just getting out. Some are getting in. But I'm trying to give you as much time and execution time as possible. As Don like said, I don't want you pulling off the side of the road in the middle of rush hour traffic to make a trade. I want to give you as much time as possible. And so I try to send them out in the middle of the day or at least an hour before close so you have the time to do it. I
All
don't know
right.
if that answered your question.
Yeah, absolutely. All right, everybody. If you're interested, let's jump in. Let's actually start trading. Let's get involved in this. 623-244-5657, theotrade.com/DC. Some additional questions coming in through the chat. I mean, just a lot of comments. You're obviously very well liked. Do we need to have the ability to trade futures, Forex, crypto,
No,
and equity options?
you need to trade equity. Equity options is a minimum. And if you really don't want to trade equity options, I'll still give you some structures that you can do. But it's harder for me to manage your risk if I can't have those options in there because we're going to collect premium on those options. But it could be what they call level 1, level 2.
Mm-hmm.
And that should be enough for anything we need to do, which means buy long calls, buy long puts, protective puts, and sell calls against the stock. That could be all you need, and I'm still going to be able to make it all the way through. That's the minimum. Because when we see currency setups, we can do a currency ETF. When we see commodity setups, we can do a commodity ETF. Now, I actively trade futures, but I do that in the futures room, and I'm usually scalping in and scalping out. The leverage is too high for this type of methodology. We're not going to hold futures contracts overnight. So even then, currencies, commodities, and things that we oftentimes do trade intraday, leveraged in the futures market or in the spot market, we're not doing that in this class. We're doing conservative, under-leveraged, not necessarily under-leveraged, but leveraged properly, currency ETFs, commodity ETFs, and substitutions for those as well.
Neil saying, give a man a fish, you feed him for a day, teach a man to fish, you feed him for a lifetime. Everyone in the chat, allow us, let us know. Are you signing up? Are you joining us? You have a choice to make right now. You can either sit around and watch all the insanity of this market, watch the S&P 500 bounce around like a ping pong, or you can actually follow the currents, follow the money. Ray asking, how long is the subscription? This is a 1-year subscription.
That includes all the alerts, the monthly coaching calls, the 12 sessions plus the bonus session, which is 8 hours. And by the way, we actually had some people subscribe to the Deep Currents in the last month. I don't know if you know this. We are giving you access to this next live session. So you may have subscribed to the previous recording as an evergreen kind of content thing. You get this class. So anyone that's here that did sign up to the Deep Currents and are watching that from the last couple of weeks, you get this class. We're giving that to you. That's a special bonus to all of you that had the confidence in joining us before. You get this class. So,
all right. So everyone gets it. And again, pay attention, everyone. I mean, the sheer amount of value that is here, almost $9,000 in value, $19.97 today. We only have 100 spots, 30-day guarantee, no questions asked. Just sign up. Give us a phone call, 623-244-5657. That's 623-244-5657. Or easily just go to theotrade.com/DC. DC for Deep Currents, not the city. That's 45 minutes away from me. Again, look at everything that you're getting today. The Deep Currents Mastermind, the methodology, which is absolutely priceless, the $100,000 Beat the Market portfolio, the weekly Deep Currents alerts, the Deep Currents coaching calls, 12 months of new updates. Again, and that Saturday course, that 8-hour course. All this stuff's going to kick off the Deep Currents Mastermind on May 6th. Plus, you're going to get that watch list and constant email support 24/7 with the room as well. Blake, we're going to wrap this up momentarily. I wanted to give you one last word before I had a quick message to everybody.
Yeah, and I don't mean to, I don't know how to state this the right way. I've thought about it a lot. My question for you is, you have no risk, like you said, 30 days. We've got a track record. We have people that are in the room that are telling you how it's a valid, solid methodology and system and community and. And then the opposite side of that is, how much did it cost you not to be there? We have people that in Deep Currents have 500,000 and larger accounts in the Deep Currents. If you would have been just stuck in the stock market, you would be down 100 and some odd $1,000. So what did it cost you not to be aware of how to benefit from the currents? And that sounds, I don't know. I'm not sure how to state that in the way that it is in my head to get those words out, but it costs you a lot more to not understand. Sometimes the biggest expenses are not understanding and not having a plan and not having structure that will keep you safe.
Absolutely.
That cost is so much greater, and there's no risk. Join me for the next 30 days. You will get trades, you'll get signals, you'll see how we're going to manage this.
100%. And again, I think you're absolutely right. There is that opportunity cost that comes with the way that the market has sold off. That feeling that you have at the end of the day when you watch a portfolio sink and sink and sink. And that's the defensive mind of this, Blake. And I think that's very important. But then there's the other side, and that's the offense. And that's what you're doing as well. You're playing offense in this environment. You're seeing where capital is moving. And you talked a little bit about this in terms of what happens when the S&P 500 fell in 2008. If you would have moved where the Deep Currents were telling you to move, you would have been up double digits in that period of time. And that's what's so critical about this. It is not just about being defensive. It is about having good, solid research and insight with you so that you can feel that conviction when you hit the buy button. And that is so important as traders as well. Knowing where the money is going, knowing where the capital is flowing, knowing where we can have confidence to make a specific trade in any given environment. And yes, the market's down 20%, S&P 500 falling the way it did, the NASDAQ falling the way it did. We talked about the Mag 7, Blake being up. And that's the question. Like, you have to make a decision right now. You have to make a decision on whether or not you're going to be one of the 100 people who are going to join today with a money-back guarantee for the next 30 days. You can keep doing what you're doing. You can obviously keep following your RIA. You can keep watching what's on CNBC, keep going with Barron's, keep chopping around and wondering what's happened. Or you've already seen the proof today. I don't think that we can provide any more proof to show how solid of a trader Blake is, what a great mentor he is, how good of an instructor he is, and the effect that he has had on the community over time. So you're going to have to think a little bit about this. I don't think you should. I think you should be a member of this team. You should join Deep Currents. You should get in on this as we start to move in the next month and have that 12-week setup. This is going to move quickly. The markets are going to move quickly. It's going to be a lot of whipsaw. There's going to be a lot of uncertainty. You need to have a good team behind you, a good community behind you on a daily basis. And once again, all of the value that is coming with this opportunity today. I haven't seen anything like this that is so comprehensive. And if you look at it once again, the 12 currents, Deep Currents Mastermind, 12-week mastermind. This is going to kick off on May 6th. So again, that's within your 30-day window. We're taking that risk off of you. You can start taking a part of it, decide if it is for you, but you're going to have 3 weeks to build this up. And then you're going to get that first week. Go in, join the mastermind, see the first week. If it's not for you, again, you're protected within that 30-day period. The methodology that Blake has walked us through, who will provide the alerts. The alerts will come directly from Blake, obviously. And $100,000 beat the market portfolio, weekly Deep Currents alerts, Deep Currents coaching call, 12 months of new updated positions. And again, these things are flying off right now. So we probably don't have 100. We're probably now starting to move into the teens on this. So please do me a favor. Go to theotrade.com/DC or call us. And you can just do that. Very easy. We have a one-on-one white glove service, 623-244-5657. Constant email support here. You can also send us a note at support@theotrade.com. And again, get those coaching calls, get that watch list. It's about $9,000 in value today. No risk. Again, 30 days to make your decision for $19.97 today. Again, in this environment, you need a good team, a good coach, a good mentor, and someone who has lived through these environments. I have followed every financial crisis going back to the Roman Empire, and I forgot that there was that big sell-off in 2013. And I remember getting beat up during that. So the highest compliment that I can give to somebody is that I learned from them on a day-to-day basis. I learned something from Blake every time I talk to him. It is a pleasure to work with him. It is a pleasure to be a part of the team with him. And I really think that you're going to get the exact same type of value out of it, being on the calls with him, getting those trades with him, getting the education from him. Again, $19.97. Take advantage of it. Be defensive, protect your portfolio, but also feel a little bit of greed, feel a little bit of urge, be excited, because in this environment where money is sloshing around, there's a lot of money for you to be made. So I want to thank you, Blake, for taking the time to join me today.
I appreciate it. Yeah, the feelings are mutual. I've learned so much I love being here. And I always like the idea, if you're green, you grow. If you're not, you rot. So
Absolutely.
thanks for helping me stay green, as well as everybody in the community too. It's
Absolutely
always engaging, keeps me green. So thank you so much.
Absolutely. Well, everybody, thank you again for your time today. We've hung out for about an hour. We got trading that's still got to be done today. But once again, this is your opportunity to join Deep Currents. Go to theotrade.com/DC, or you can call us. The phone number, again, I'm going to throw it up on the screen for you just so that you can see it as we wrap this up. And I don't think you're going to find a better deal at this time, particularly in this environment. You can just give us a call at 623-244-5657. I hope everyone has a great day. Thank you so much for trading with us. And I'm looking forward to seeing everybody when we are live on Monday. Remember, we are not trading tomorrow. It is a quiet day. No market open tomorrow. We will be back on Monday for a full day, and obviously pay very close attention over the weekend, because we will all share our insights and expectations for what is going to be a wild week after $3 trillion in options contracts expirations today. Everything's setting up for a wild week next week. Looking to make sure we had all the questions answered. Looks like we did. All right, everybody, have a great day. I'm going to leave the number on the screen, and if you would like, you can also just take another real quick look at everything that you're getting: the Deep Currents Mastermind, the methodology, the $100,000 beat the market, the weekly Deep Currents alerts, the Deep Currents coaching calls for 12 months of new updated positions, the Deep Currents watch list, and that 24/7 room, and the email support. Again, Blake will not be up at 3 o'clock in the morning, but he will be up to ensure that you have all the information you need. And you can go to theotrade.com/DC or call us once again at 623-244-5657. 56, 57. Have a great day, everybody. Thank you.